Good morning, everyone. This is Daily Trading Analysis with the weekly recap for this week. And as always, we are going to review the fundamental data, the news, top news of the week, and also the technical charts from top to bottom, from the weekly, going through the daily, and into lower time frames to really see all the details that you need to consider that happened this week to be prepared for next week. Let me tell you that this week has been a lot of red, a lot of bad news, and a lot of mis expectations. And I think we have to realize that the market is actually understanding the situation and adjusting their expectations. You know that expectations move the market. And right now, those expectations in terms of earnings and also in terms of worldwide economy and the conflicts in the Middle East and Russia, Ukraine, those expectations are lower and lower. So with that in mind, we are going to review all the data and trying to see the justifications, all the evidences that you need to be aware of for understand this situation that I'm sharing to you and also be prepared for next week. So first, fundamental data. Monday, we have a couple of Feds saying, it's the same Fed, but there were two actually, two speeches from Fed Harker saying that he considered that the interest rates are tight enough for inflation to come down to the target of the 2%. On Tuesday, we got retail sales, and that was the first missed expectations. We were expecting way lower readings than the ones that we got, and that means that consumer spending is still pretty high, pretty high. In terms of industrial production, we got a little bit of upticks. That's not affecting too much inflation, it's just avoiding some of the fears on the recession. And finally, more Feds: Bowman, Barkin, and Kaskari. All the three saying on Tuesday that more or less they think that inflation remains high. We've been seeing progress towards the 2% target to the downside, but there's still more to do. And they think the best thing that the Fed can do is just wait, so maybe skip a hike the next FOMC and see how data continues coming up to confirm that the inflation continues progressing to the downside. Wednesday was really interesting because we have a lot of Feds, and there was a lot of expectation on Thursday Jerome Powell's speech, but for now we got the MBA 30-year mortgage continue creeping towards the 8%, and it actually hit 8% on Thursday. So the mortgage rate is super high, following the interest rates for the Fed funds rate. The 30-year mortgage, it's a pain for a lot of households. Building permits creeping a little bit higher, lower than the previous one, and showing now a little bit of weakness on the month over month. Housing starts are, well, at least they are pushing a bit, 7% on the month and 1.3 million, more or less as expected. But these two sectors are, we know for a fact that they are already cooling down, so they fluctuate a little bit. The main reading was the 30-year mortgage confirming a lot of pain for the mortgages. And more Feds, what did they say? So they started to think about what I said on Tuesday. Fed Kaskari, they confirmed, Waller, Williams, Bowman, and Harker confirmed that they think that the policy might be appropriate to continue seeing progress to the downside for inflation, and the best way moving forward, the best path for the Fed is just to wait and see more data. Thursday and Friday was a bloodbath. Thursday, a lot of speech and Jerome Powell saying that he doesn't think that monetary policy is tight enough. Contrary to other colleagues, he said something that really crashed the market. And not only that, we also had some other news, like for example this one dropping on Thursday, that US State Department issued worldwide caution alert as tensions in the Middle East soar. Remember that Joe Biden tried to pray for peace, flying to Israel to meet Netanyahu, and trying to build a peace or to build a aid corridor or not to escalate tensions in the Middle East. And Biden did not succeed. He come back to US and then US issued this worldwide caution. So US tried, but we couldn't do anything. So that increased the fears about maybe the conflict will not escalate further, but I think there's a lot of fear of actually escalating. Iran, North Korea, Saudi Arabia, Russia are interfering between Israel and Gaza, and Palestinian people, also some borders, Egypt, are not clear. There's a lot of tension there. And I think that really affected the markets to the bad side. And also Jerome Powell, don't forget, going contrary to the other speech people. And Friday, more of the same. Higher for longer. We might be flat, but we have to wait, see more data, and more of the same. So really hot week in terms of Fed speeches. And I think what is clear is that not too much fundamental, but what the Fed was saying was really changing the overall sentiment. And we are going to see that in the charts. In terms of earnings, we started the week finally with the end of the banks reporting, and they were quite good. I mean, they were topping expectations because interest rates, income, and the inflows of money. But then we got Tesla and Netflix. Netflix, on one side, we got huge upside, huge earnings, a lot more subscribers, and looks like Netflix is not seeing any outflow of subscribers despite the fact that they increase 1, 2, and now 3 times their paid monthly subscription. So they are good and they are continue pushing the consumer. Corporate greed is something Netflix is aware, but looks like it doesn't care. So topping expectations, bad for consumers, but really good for stakeholders. And Tesla was a little bit of a surprise for some people, but I think we understand that Tesla is now cooling down, is now seeing the first time since 2009 that Tesla missed top and bottom estimates. So bad sentiment for Tesla, and that's down on the week 15%, the worst performance of the year. So that's really affecting technology because looks like perhaps some of the other technology companies that are going to report in the upcoming weeks are not going to see the same profits and the same margins that they were used to. That's key. The rest mixed. And finally, we are seeing some regionals starting, Berkshire Hills Bancorp and Regions and Huntington. And looks like there are concerns regarding not big banks, but the regional banks. We are going to see on the charts that KRE, the regional banking sector ETF, it's not looking pretty good. and big banks are seeing higher interest rates income and no outflows, but regional banks that are getting also somehow high interest rates income, they are struggling to keep accounts, to keep the inflow of consumers. And they pay to have those accounts. So basically, they are getting their profits on interest rates, their income to pay for those outflows. And the situation, the outlook is not really good. So that increases the fears of again seeing the same thing that happened earlier on the regional bank crash. So these fears are fueling more the bad sentiment on the technology and the worldwide economy. So be really careful. Watch this regional banking. I will be covering that and to find correlations, and be really careful because the red might happen again following the struggle of these smaller regional banks. In terms of interest rate probabilities, we have the same as always, and something that may be good is that the interest rates probabilities for these 2 months, December and January, are actually decreasing by a lot. This was 40% and 30 something, and this was 40%. And now we are seeing again the downstairs, the stair stepping down of the interest rate cuts. So again, the same thing as earlier in the week. Now we are going to touch something that I usually don't cover, but I would like to mention for you guys, the ones that follow cryptocurrencies. Cryptocurrency is quite hot on the optimism on the ETF, and they are actually crossing 30,000 again. We are going to see that on the charts. So if you are trading crypto, we are seeing a little bit of inflows on that market. Now that we covered the fundamentals, news, earnings, now we are going to the interesting thing. Let's start with the Bitcoin that I was mentioning. We were in the long term, we were trying to reclaim these 31,000 since November last year. And this year has been a little bit of struggle. We went higher, but then we got, this is the weekly chart, by the way, we got this big flash. And then since then, we are trying to curl of 25,000. And if we check the daily, it's quite clear that this was distribution. We went lower and then we crashed the market on news. And since then, we've seen weeks, a lot of buyers coming up. And finally, 2 big days, Monday and Friday. Tapped on the 30,000, and this week reclaimed here. It's something quite bullish. Let's see the volume, big volume on Monday, and also quite decent volume on Friday. So Bitcoin is hot, let me tell you. Let's now go to Nasdaq. Nasdaq on the week has a lot of issues. After last week, topping tail, right on the descending trend line, we find ourselves this week closing at the lows. Closing at the lows means a lot of pressure. We don't have the opportunity to even find buyers at the end of the week. So this is quite bearish. Quite bearish. Big red fat candle. Closing at the lows means potential for more downside. And this is the context on the weekly. Quite bearish. On the daily, we can see the context that we have, the double bottom, the descending trend line as always failing for the 4th time. And look at this week. 1, 2, 3, and 4 times we went lower with certainly a lot of volume. So I can see more potential to the downside. I can see a lot of shorts pushing and a lot of big participants. Some people might say that this is support, but within this context of 4 times tap and we couldn't go higher, we were rejected. I think this is a descending triangle that may resolve lower on this part and then move lower. So I was hoping here for a higher low, but if we treat this as support breaking down, is even more bearish. So I don't have anything else to tell you guys. So this is quite bearish. And if we see Friday's performance and the 1 minute performance since Jerome Powell, we've been crashing the market in a very decent way. This is pre-market, and then at the open again another crash. So quite clear price action, the downside, in my opinion. And be real careful if you continue pushing longs and forcing longs, because this thing, let's see now the continuous chart on the NQ, this thing can really break down. The next support thing, quite visual, is 14,200. That's 500 points less than the current close on the week. And in terms of potential for that, we have 3%. And the next one, I don't know. You really see what I'm seeing, right? We might be closing this below. We have also this small support, but look at the 200. The white line is the 200 daily moving average on the continuous NQ chart. So in both situations, we have a lot of downside. The first small support down here, it's 2.7%, almost 3%. And then we have the 200 moving average with almost 5%. And then the big support at 6.5%. A lot of potential to the downside, in my opinion. Be really careful. In terms of individual stocks, well, we are going to see something similar in all of them. This descending trend line, rejection at that trend line, and then moving lower. Some of them filling the gaps and some others really seeing a lot of weakness. Apple, well, look at this bad day on Friday. And we have this gap that I think we are going to feel quite soon. The 200 moving average is in the middle. It's right here. And I think we might see some kind of feel like this. So Apple, more potential to the downside. Microsoft, this was quite surprising. It was breaking. It's the only one breaking the descending, but on the break point, this was a lot of shorts, a lot of resistance. It couldn't even go to the 34 price on the second tap. A lot of weakness, and then coming back down from the breakpoint. I mean, it's not weakness, but it's not able to hold. We are in the middle of the two moving averages, the 45 and the 20, and then we have this support. So if we start coming back down again, I think this is an obvious target. Tesla really crashed technology this week. The gap on earnings, huge gap, $12 gap, and then continue lower. I mean, it filled this gap, so we can now remove that. And we had two trend lines. This one, short term, that was rejected, broke down. And then we have this monster since the start of the year that we also broke even on a gap down. So that's a lot of signs of weakness. A lot of signs of weakness. We can now, I'm going to clean a little bit. Let's move that. This is just going to the gap, and now we have cleaned up. We are in a gap, almost entering a gap, but 200 is, I think, is psychological, and we might see a little bit of really bounce, but then continuing towards 200 and continue filling gaps. I don't think Tesla, and also remember this long-term trend line, I don't think Tesla will be able to reclaim the gap and stay in range again. I don't think so. Amazon, consumer discretionary. Well, how are consumers doing? Looks like the outlook is not good. It's not good. We have this base down here and we are almost there. We almost fill the entire gap. We are a little bit of gap that we filled in here. But again, below both moving average and the 200 might be support in the midterm, but I think the outlook is more weakness on the consumer discretionary and Amazon side. Google was the only one that broke a local pivot, pushed 2-year pivot on February 2022, and it couldn't hold. Looks like Microsoft and Google are pushed up by AI. So looks like AI is now feeling a little bit of weakness, but at least Google is above the two moving averages, the 20, the purple line, and the 45 blue line. So Google, a little bit of pullback. That's what I'm seeing. We also might try to follow this kind of uptrend. This is not crazy. This is a channel that he's following. So if you want to look for Google and you want to trade individual stock, I might try to find some opportunities around here. That's 133, 132, 132. Nvidia, the crazy one. Look at this. This is a big head and shoulders that not a lot of people, but I think enough people is watching. We are just well, we are just at the neckline. Remember that the head and shoulders resolve to the downside on the neckline, and we are right there. So my forecast is that this head and shoulders is going to resolve properly. We are going to fill this gap, and we are going to move towards the huge gap down here on earnings. We failed. The dashed orange line is quite clear. We have two shoulders, and we are right below. We are right at the bottom of the right at the spot of the neckline. This is too technical. So in my opinion, I think these things resolve with high probability most of the times. So look for that resolution. And Meta tried and failed. It's that simple. It's like Google and Microsoft pushed by AI, and it's above the two moving averages. So quite strong. Meta it's quite decent. We have also this sending support that might be, look at these buyers. So we might see buyers down here around this. So that's the performance. I can see a lot of potential to the downside this week. Continuation, not only due to individual stocks, but also Nasdaq is at the right spot for a breakdown. And Can we see some correlations? Well, dollar, it's again in range. It's at a point at which if it breaks out and continue pushing 108, it will put a lot of pressure down to the stocks. Yields pull back a bit. I think yields pulling back is not certainly bullish because I think they were quite extended. Look at the 2-year yield that was at 5.25%. That's crazy. It's still above 5. And the 10-year, 5.001%. It tapped and retraced. And I think that's something at least optimistic, but it's not bullish. There's certainly a lot of people on this market, on yields, they are pushing higher. And treasuries continuing going lower. I was watching this zone and it failed tremendously. And we are continuing moving towards May 2007. We continue going lower and lower and lower. And we are at these levels. Look at this. There should be a lot of buyers down here. There should be, right? We are at the level at the treasuries I think are going to skyrocket. If I was a big investor, I would like to just buy on this zone. This zone is quite attractive. It's the low, the history low. It's history low. So prepare for that. Follow treasuries and watch yields too, because those at least will provide opportunity to see if there are other sectors and markets that you are interested. That doesn't mean that Nasdaq and technology and S&P is going higher, but at least you have other opportunities. Russell 2000, more of the same. We are breaking down this support quite heavily. Look at this closing on the lows. Super bearish. Next spot to watch, 162. It's quite clear. And the bad thing is that since the close, that's 2%. 2.5%. So small caps struggling, small businesses struggling. Why? Because the higher interest rates that they need to pay for their loans. It's that simple. So small caps suffering, UK 100 for the Europeans like me. Look at these 3 days. UK 100 lost 4.28% in 3 days. Unbelievable. Unbelievable. And it's obvious that this zone, there's a lot of shorts. I had charted a little bit of local ascending trend line that we got rejected like a knife. Look at these candles. And now where are we? Well, we are at a long-term. Oops. I'm watching a long-term trend line right here, and that's right here. So we broke that one, and we are finding ourselves at some kind of support, but I think this is a zone. If not, prepare for 70 to 40. What else? Banks. As I was saying, KRE, the regional banking ETF, this was the crash on March. This was a retest and failed, and look at where are we. Below the 200, below the 45, and now below the 20 on the daily. Super bearish. So my spot down here at 36, that's like 7% more downside potential. So regionals have the key to the performance and also small caps, and everything is correlated. We are seeing weakness where weakness is due, and we are seeing strength where you think a lot of people is moving. And that one thing is gold. Look at this breakout. Gold is the safe haven for a lot of people, breaking strong break towards 2000. It tapped 2000 and retraced. Watch this zone because I think gold might have more potential towards higher levels. This is a target 2058, and I think there's a lot of money outflow from technology and equities towards metals. Why I think that? Because if we check the sector funds performance, this is a 5-day performance. We are seeing energy, staples, healthcare, and utilities, defensive sectors up on the week, not on positive, but they are not struggling as technology, regional banks. Look at where are regional banks down here with consumer discretionary. And if we check the 10-day, this is the usual test that I do to find if there's clearly rotation to defensive. We have energy crashing on a 2-week performance. And look at this. Utilities, staples, and also healthcare up here. The offensive and the risk on assets are down here. So in my opinion, there's a clear rotation to defensive sectors and also these safe haven assets like gold, like dollar is not seeing that much rotation, and also some people is pushing Bitcoin. So treasuries might see also a push, but what is certain is that this defensiveness on Wall Street might affect technology, which is obviously a risk on asset, and it's something you have to watch. If gold continues pushing higher, dollar continues pushing higher, treasuries start finding a lot of buyers, prepare for a huge downside on equity. It's that simple. Copper, it's basically quite bearish, and this is not related with the safe haven, but it's related with the worldwide economy and China demand. We find ourselves down here on a big descending triangle. We tried to move higher. I had a local wedge that failed. So what is next? Well, we are right here. And the potential to the downside is huge. Huge for copper. From there to there, it's 8%. So watch copper, because if copper starts rejecting down, we might see more weakness in the worldwide economy. And certainly that will affect performance on US risk on assets like Nasdaq, like small caps, and watch regionals, watch banks, watch earnings. There's a lot of things to watch, and you just have to see those correlations. If dollars continues higher, if treasury starts to push up, yields hold, and you see gold pushing, getting more inflows, and obviously the individual stocks start continuing. There's a lot of potential in all these tech stocks. The big tech companies are getting crushed. Obviously, you have to adjust your expectations and look for more downside. It's the logical thing. And I think we have to be prepared for that. I think it's going to happen. There's a lot of correlations, a lot of volume to the downside, open interest pushing on down days. I mean, sorry if you are a bull, but I'm following the technical and the fundamentals, and everything right now is correlated to the downside. So be prepared. Draft your plan, manage your risk, be disciplined, be patient. Because next week I think is going to be, it might be even more red than this week. And that's all from my side. As always, if you found this video useful, please give it a like, subscribe to the channel. I do these weekly recaps every single week, and I do also daily market reviews, market updates, and market forecast every single day. So subscribe to the channel. I put a lot of content. I try to teach you my way, to share with you my way of understanding these markets, teach you some things. And if you find this information useful, please support the channel. Thank you for those subscribing, and let's see what happens in terms of the market. Let's have this weekend as to try to rest. This week has been quite red, and let's prepare for next week because it might be even worse. So stay safe, everyone. Have a nice weekend, and see you on Monday.